Welcome back to another portfolio update. In this episode, I'll be talking about how much I think you should have in bonds, and this depends on a lot of different factors, which I'll get into after the portfolio update. So this is the M1 Finance. It's doing well. Haven't really changed much. The stock market's been on a roll lately. It's been nothing but up. The coronavirus had a little bit of a dip, but besides that, we've been doing well. Robinhood, of course, doing great. I have about 70% in the S&P 500, and then I have the rest into dividend-paying stocks as usual. M1 Finance, again, this is all about dividends. This is all about dividend income. I'm just not worried too much about growth. I'm not too worried about the market gains. I'm more worried about the earned dividends, and I like to see that number going up. And so I also have January's update. So January is a month where not a lot of companies pay out dividends. So don't be too alarmed if your dividends for January are lower than usual. That is the case with both M1 and Robinhood. Robinhood might also be because I've been selling out of quite a bit of stocks, but it is lower than I would like, but it is still above my targets, and that is all that matters. As long as I'm staying along this line, I'm happy. Same with portfolio value. You can see this is not going to be as accurate because I'm putting in a lot of money just to earn interest. As you can see from this one, I'm just earning some interest on the side. That's pretty much risk-free money right there. All right, going back to the portfolios. Again, I treat this one like a house. I get rent payments every month, and the bigger my house, which is the bigger my entire portfolio, the more rent I will be able to make. But here's the key. As you can see, I have about 15% of this one in bonds. So bonds pay monthly. Bonds usually pay about 3%, maybe more, it depends on the risk tolerance of the bond. But usually bonds pay monthly and they pay pretty good dividends, which is why I like them, which is why I have them as 15% of my portfolio. But for some beginners, you might not even know what a bond is. So a bond is simply just a loan that a company makes. So they issue bonds, they sell them to investors, and investors buy the bond, which basically just gives the company money, and the money pays interest on that loan, and then at the end it pays it back, just like a regular loan, just like you get with your credit card. So a bond is debt. So there are three main types of debt that I wanted to talk about. You have mortgages. So these are personal debt. These are personal loans, but they can't be bankrupt. They're collateralized with equity in a house. So they are really safe. And so I have 5% of my real estate. This is NRZ. They focus on mortgage-backed securities, stuff like that. Super high dividend, 11%, but it's pretty risky too. So that's what I have in mortgages. So it's 5% of my real estate. Then there's also Treasury Bonds, and we can go back, and I have about 30% into Treasury Bonds, 1 to 3, 7 to 10, and 3 to 7. Treasury Bonds are basically the same as investing in the dollar bill. You're investing in the federal government. The Treasury Bonds are basically the government acting as a corporation, paying you interest on debt that they borrow. However, as you can see, the returns here are very modest. They're very safe. They're essentially risk-free. Finally, I have corporate bonds. That is these LQD. These have, as you can see, a little bit bigger return, a little bit more dividends, but it's a little bit riskier. These are bonds by large corporations in the stock market. These are things like Coca-Cola, Procter & Gamble, corporations like that. These are bonds that I'm investing in there. Another common question I get is how to invest in bonds. The simplest way is to simply just buy an ETF on the stock market. So LQD, Bond X, this is international bonds, SPBO, corporate, and these are treasury bonds. That's the simplest way. You can also go and actually buy a bond, but that process is long, and it's much more complicated than just simply buying an ETF, where you can actually just track an entire index of bonds. So that's how you invest in bonds. That's what bonds are. Now we'll get into how much should I have in bonds. And so the unfortunate answer to that is it depends. It depends on your personal risk tolerance, and it depends on your age. So as you become closer to retirement, as you get older, you want to be able to take out your money even if the market is down, so you want to have a more risk averse portfolio. So you want to have more in bonds, which is more like cash. And so the reason bonds are safer than stocks is because the company is required to pay out its bondholders before its shareholders. So if the company is going under, the bondholders have a much higher chance of getting paid out than the stockholders do. They get what's remaining after they paid out all of their debt. So if a company liquidates its balance sheet and it has as much assets as it has liabilities, then the stockholders get nothing. So take that into consideration when you're talking about bonds and equities. That's the main difference. That's why bonds are so much safer, or it's perceived safer. But you're still investing in that company. If you were to buy a Coca-Cola bond, you're still kind of investing in Coca-Cola because you're banking on Coca-Cola to pay you back. And if they go under and they have more liabilities than they have assets, then you will not get paid back. So that's why bonds are safer. So how much should you have in bonds? That depends on how much risk you're willing to take. For me, I personally don't mind a lot of risk. I'm relatively young. I have a long ways to retirement. I want to be as aggressive as possible. And so this article gives you a pretty good idea about how aggressive you want your portfolio. I have mine in about moderately aggressive, so about 80% in bond or in stocks and about 20% in bonds, maybe even a little less than that. But if you are getting closer to retirement, you want to start moving your portfolio. You want to start tailoring it more towards bonds, less towards stocks. So a good rule of thumb is to subtract your age by 110, and that's how much you should have in stocks. The rest should be in bonds. So for example, if I'm 30, you would subtract 110, you subtract 110, you subtract 30 from 110, and that gives you 80. So I should have about 80% in stocks and 20% in bonds. And then when I'm 40, I should have, 70% in stocks, 30% in bonds, and so on. And that will help you give you just a really rough guide on how much you should have in bonds and stocks as you age and as you accrue wealth, and as you might need to start taking it out if you retire. So that's just my 2 cents on how much in bonds you should have in your portfolio. It really depends on your risk tolerance and your age. Those are the two main factors. But if you don't really need to take out money and you're willing to see your portfolio go down and up like a lot and with the market, then and if you're young, you don't need to take it out, then have close to 100% in stocks. That's my opinion. Just for example, bonds earn about 4% a year, while stocks earn about 10%. So if you were to invest in LQD only, you would earn about 4% a year. If you were to invest into the S&P 500, you'd earn about 10%. And that is a huge difference over the long run. So I hope this was helpful, and I'll see you guys next time.